right, today we're talking about entrepreneurial financing, and we are looking at a spectrum of various options that entrepreneurs can use to generate financing. On one side we've got your job, your savings, your credit card, your mom, your Uncle Larry. This is the least sort of intense and onerous area to raise money, moving all the way down to angel investors and early VC. Specifically right now I'm sort of in this section right here, which is called what I have referred to in the past as the commercial section, and we're going to talk about bank loans. The commercial section and bank loans, and then moving forward to angel and VC, are driven almost entirely by dollars. These guys are trying to turn a little amount that they lend you into a big amount that you pay them back. So make no mistake sort of about their motivation. They're there to make money. Sometimes these loans can be funded by different sources that have other goals, but they're always there to make money. So we're talking in particular about home equity loans, HE, home equity loans, today. So what exactly is a home equity loan? Most of you probably know this. We'll just go over it very briefly in terms of how it relates to other sources of equity financing. Home equity loans are essentially a line of credit that you can draw upon, meaning that the bank doesn't necessarily write you a check. They'll give you a certain amount of money that you can borrow, and you can write checks and draw upon that money when you need it. So it's a line of credit. They generally have a high interest rate associated with them, certainly higher than your mortgage because there's additional risk, and oftentimes almost as high as a car loan or similar to a car loan depending on your credit, and this varies widely based on your credit score. Also, you're using the house as collateral, so when you do go sell the house, by law you have to pay off your home equity loans. They're essentially, they will seize the asset were you to go into bankruptcy or forfeiture, which sadly lots of folks are struggling with that problem right now. So let's look at the math. Here's your house. It's a bad drawing of a house here, but you've got your little house that's worth $500,000, say. So this is the overall value of your house. So if your house is worth $500,000 and you are either a lucky or smart person and you've taken out a mortgage, but your mortgage is only $300,000 and you're paying 5% on that mortgage interest, great, good for you. You've got your monthly mortgage payments that you're paying every month, and you owe the bank $300,000. You'll pay it down over time. Of course, you're going to pay some of the principal and interest with every payment. So a home equity loan in this case, if you owe the bank $300,000 and you have a $500,000 house, then you have what's called $200,000 of equity, meaning you've built up equity value in the home. So that $200,000 is yours. That value, were you to sell the house for $500,000 minus what you owe the bank, you'd end up with $200,000 of your own money. So a home equity loan essentially is you borrowing what is already your own money. You're borrowing the equity that you have in the house. Granted, we all know from recently that house prices can fluctuate, so that amount of equity may go up or down. But you can borrow that equity as a line of credit from the bank in terms of cash. So here's your home equity loan. It's not necessarily a loan, remember, it's a line of credit that you're going to draw upon. Let's say the bank says you can have 40 grand of this. So now you can write checks periodically, episodically. You can write checks anytime you like until the total adds up to 40,000 bucks that you've borrowed. The challenge here is that these will have higher interest rates associated with them, call it 8 to 12%, than your mortgage, which would be at 5%. So a lot of people borrow money, to pay for college educations or to make consumer purchases. But in this case, if you're trying to start a company and you need funding to start a company as an entrepreneur, a home equity loan might be an option. You might say, you know what, it's only at 8%, it's a really easy loan. It's easier than an SBA loan or a commercial bank loan. I really don't want to go to angel investors and sell a bunch of equity, and I've tried all these sources of funding and they either haven't worked or I've exhausted those sources. So what I'm going to do is I'm going to go borrow money against my home from the bank, and I will use that money to grow my business. So remember, the value of your home minus what you owe the bank is how much equity you have in the home, and a home equity loan is simply you drawing upon that equity from the bank.